Assalamualaikum and hi everyone. We are from Group B1 going to present to you about the MFRS 133 earning per share for the CC1 FAR 5. So this is our group members consists of Farah Adila binti Idris, Amanina Fasihah binti Rusdi, Tessie Chen, Nur Atika Balkis binti Saharin and also Nur Syafiqah Atika. Assalamualaikum and hi everyone. So my matric number is 291204. My name is Farah Adila binti Idris and I will be presenting a brief summary of MFRS 133. So this is the key definitions. Anti-dilution refers to an increase in EPS or reduction in loss per share. Dilution is the reduction in earning per share or an increase in loss per share. While ordinary share is an equity instrument that ranks below all other types of equity instrument. Potential ordinary share is a financial instrument or contract that could give the holder the right to obtain the ordinary share. We also have option, warrants, and also equivalents. Put options are contracts that allow the holder to sell share at a fixed price. And lastly, contingently issuable ordinary share are shares that will be issued for little or no payment once the certain conditions are satisfied. Now, let's look at the key points of MFRS 133. The first one is calculation of diluted EPS. When the potential ordinary share exists, there are options, warrants, convertible instruments, or any contract that can be settled in shares or cash. The company must test if they will cause a dilution or not. If they are dilutive, there are specific rules to follow. First, for option and warrants. Second, for convertible instruments. Third, for contract that can be settled in share or cash. And lastly, they will need to follow any other necessary provision if it was needed. And the second one is contract settled in share or cash. If the company can choose, they should assume whether they can settlement it in share if it causes a dilution. But if the holder can choose, they should use whichever option that causes more dilution, whether it's a cash or share. Also, if a contract is partly treated as a liability, the company will need to adjust the profit or loss for EPS calculation purpose. Now, let's continue to the more key points of MFRS 133. And the third one is presentation. Company must present both basic and diluted EPS directly on the statement of comprehensive income. They will need to show the EPS for three areas in terms of profit or loss from continuing operations, overall profit or loss, and last one is each class of ordinary share with different profit sharing rights. Even if the EPS is negative, they must show it. If there are discontinued operations, their EPS must be disclosed separately. And the next one is disclosure requirement. For this, company must disclose the numerator and denominator for that used for the EPS calculation. Second one, instrument that could dilute EPS in the future, but they were anti-dilutive during the reporting period. And the last one is any important post-reporting event that would have changed the number of shares that are outstanding. And lastly, it will encourage to also disclose the detailed terms of any instrument that will create potential share. So this ensures transparency and help users of financial statement to understand the EPS figure better.
Today, I will be discussing how three accounting theories. The first one is the normative accounting theory. The second one is the positive accounting theory. And the third one is the regulatory theory, relate to development and purpose of FMRS 133 earning per share. Let's start with normative accounting theory. This theory is perceptive, meaning it's focused on how accounting should be done, based on ideal objectives like fairness, transparency, and consistency. MFRS 133 reflects this normative approach by setting out what is considered best practice for calculating and presenting earnings per share or EPS. The standard provides consistent rules for calculating both based on diluted EPS and offer details, guidance on dealing with financial instrument and capital change, such as share split, right issue, and potential ordinary share. The aim is to prevent manipulation and maintain consistency across different periods and companies. In short, MFRS 133 upholds normative theory principles by enhancing the integrity of financial reporting and ensuring that user get clear and fair representations of a company performance. Next, we have positive accounting theory, which take a different approach. Positive theory is descriptive. It tries to explain real-life accounting practice by analyzing how managers behave and what motivates them. It assumes that managers often act in their own self-interest, especially when things like their salary or job security depends on financial measures like EPS. Before MFRS 133, companies had a lot of flexibility in how they collect EPS, which sometimes lead to manipulation like selective trading convertible instrument or share-based payment to make earning look better. MFRS 133 was partly created to address this behavior by setting strict rules and requiring full disclosure. It reduced managers' ability to manipulate numbers and ensure that financial reports are more trustworthy. From a positive accounting theory perspective, MFRS 133 is seen as a reaction to this behavior observed in real company. Finally, regulatory theory. This theory focuses on the role of regulator and standard setting in creating rules that protect the public and promote market stability. MFRS 133 was developed by the Malaysian Accounting Standard Board and aligned with IAS 33 as part of a global effort to harmonize financial reporting through the IFRS framework. The goal was not just to make EPS reporting comparable across country, but also to protect investors by ensuring earning data is consistent, transparent, and reliable. Regulatory argue that without formal standard and enforcement, company might adopt inconsistent practice that could mislead investors and the stock market. This issue of MFRS 133 show how regulators step in to enforce discipline, build investor confidence, and protect the credibility of Malaysia capital market.
Okay, now I will continue to present about the main parties that involved in the development or formulation of MFRS 133 earning per share. Okay, there are 4 parties that involved in this development, which is first is Malaysian Accounting Standard Board, which is MASB. Second is International Accounting Standard Board, IASB. And third one is International Accounting Standard Community, IASC. And last but not least is IFRS Foundation. This part, I will explain more about all the 4 parties that I have mentioned just now. Okay, so first the IASC. IASC was the actually first one to come out with IAS 33 earning per share with bets in February 1997. They basically introduced the original rules on how companies should calculate and show earning per share. And then in April 2001, the International Accounting Standard Board, which is IASB, took over from the IASC. And they adopted the IAS 33 and later updated in the December 2003. They also added an extra guidance from something called SIC 24 and make a few small changes to other standards like IFRS 10, IFRS 11, IFRS 13, and last but not least is IFRS 9, just to keep everything consistent and up to date. After that, in November 2011, the MASB issued the MFRS 133 here in Malaysia, and they made sure it was equivalent to IAS 33, meaning that company following the MFRS 133 in Malaysia are actually following the international standard too. And this move was part of Malaysian plan to match our standard with global ones. And last but not least is they are the IFRS Foundation, and they are the ones who own the copyright for the IAS 33 and all the IFRS standard, and the IFRS Foundation give permission for the standard like MFRS 133 to be used here and make sure everything stay consistent around the world.
Now, I will be presenting about the nature of MFRS 133, earning per share, and how it reflects a principle-based accounting approach. MFRS 133 outlines how companies should calculate and present EPS, including both basic and diluted EPS. This standard applies to companies that have publicly traded ordinary shares or are in a process of issuing them. EPS is a crucial figure used by investors, analysts, and stakeholders to assess a company's profitability on a per-share basis. What makes it interesting is that it is a principle-based standard rather than a rule-based standard. So what does that mean? In simple terms, a rule-based standard gives detailed instruction for every possible scenario, but the principle-based standard provides a framework of objective and allows professional judgment. This makes the standard more flexible, especially when companies face complex or unique situations. For example, when calculating diluted EPS, MFRS 133 requires company to include all dilutive potential ordinary shares, such as share options or convertible bonds. However, it doesn't give a detailed list or step-by-step method for every case. Instead, it follows the principle like include instruments that would decrease EPS and exclude those that would increase it. This allows company to use judgment to decide what dilutive and what's not. Next, MFRS 133 use of weighted average ordinary shares during the reporting period. The standard provides guidance, but companies go through share splits or bonus issues. They need to apply judgment to ensure the EPS reflect the real economic impact. This principle-based approach has several advantages. It encourages companies to present financial data that truly reflect their economic position rather than just following a checklist. It also improves comparability across companies and reporting periods, which is helpful for financial statement users. In conclusion, MFRS 133 shows how the MFRS framework is aligned with IFRS by focusing on principle, judgment, and transparency. Although it gives less specific instruction, it provides the flexibility to handle real-world complexities while still delivering reliable and meaningful.
For MFRS 133 earning per share, it has several limitations. One of them is limited applicability. EPS only applies to entities with publicly traded ordinary shares or those in process of issuing such shares. But for the private companies, even if they report under MFRS but are not required to disclose EPS, this will restrict comparability between public and private entities. Next, MFRS 133 focuses only on basis and deducted EPS, but doesn't cover adjusted EPS, which many analysts find more meaningful. Companies may report adjusted EPS excluding one-time item, but without standard rules, this figure can be inconsistent or even manipulated, which make comparison across companies unreliable. Another limitation of MFRS 133 is the subjective assumptions in diluted EPS. The calculation of diluted EPS relies on theoretical assumptions. This can mislead users by showing a lower EPS and making the company seem less profitable than it actually is. In addition, there was no standard adjustment for non-recurring items. Earning per share under MFRS 133 does not adjust for extraordinary items like natural disasters losses, discontinued operations such as selling a business division, and other non-recurring earning components. It will make the comparison between companies less reliable. Two firms with similar core earnings could report very different EPS due to unusual events. Also, EPS can be manipulated, which has potential risks as the companies might use tactics like share buybacks to inflate EPS without real profit growth. Over-reliance on EPS alone can mislead investors if other factors like cash flow aren't considered.
Okay, so for 6.0, I'll be sharing suggestions to overcome the limitations of MFRS 133, which deal with earning per share. So first, we suggest the applicability of MFRS 133 to private companies, especially those that voluntarily to adopt the MFRS standards. This will improve comparability between public and also private entities, and also simplify the EPS framework, could also develop specifically for private companies. And secondly, we recommend to standardize the computation of adjusted EPS. Clearly, guidelines should be introduced to all people, specifying common adjustments like reconstructing costs and non-recurring gains or loss. This will make EPS figure more reliable and comparable across the industry, benefit both investor and also analysis. The first one is enhanced training for accountants. This means that we can provide practical training using workshop in case for case study and stimulation that can greatly improve their accuracy, their compliance of EPS calculation. So this will ensure that the users of financial statement can trust the EPS figure that being reported in the financial statement. Okay. Second, we recommend to simplify the language of MFRS 133 by rewording the standard of easier to understand, especially for small companies. We can add the real world example, we can reduce the misinterpretations and also encourage wider adoption for the standard. Overall, these changes is aimed to make the MFRS 133 more accessible, more practical, more reliable for all type of entities. Suggest to reduce the subjectivity in diluted EPS. This means that this can be achieved by enforce the stricter rules on conversion consumptions and exclude unlikely conversions such as options that are unlikely to be exercised. So this will improve the accuracy and reliability of diluted EPS figure. And second one, we recommend to exclude the non-recurring item from the EPS. Adjustment should be made to remove the extraordinary one-time events like natural disaster losses or business division sale. So this ensures that EPS will reflect the company core operating performance more accurately. And finally, to prevent the EPS manipulation, companies should strengthen the disclosure requirements around share buybacks. And from this, they must clearly explain the impact of buybacks on EPS, motivation behind them, and long-term financial effects. So this will help to reduce the risk of misleading EPS figure. So together, these are the suggestions aimed to make EPS more consistent and trustworthy measure for investor and. So I guess that's all from us. Thank you.